Today on Think Smart with TMFG, Mike and I are going to be discussing the upcoming bear market.
Bears are scary, aren't they?
They really are. I was thinking about you, given the market reaction last week where we saw a bit of a pullback, and you'll go into that in more detail. But I was thinking about, you and I have very different cottages. My cottage is up in Muskoka. We see the odd deer, we see raccoons, the odd fox. But really, in the last 20 years, I've seen 2 bears.
Yeah.
But your place is on the edge of Algonquin Park, and you like to go canoeing, you go on canoe trips.
Go where the bears are.
You like to go where the bears are. So what do you do to get ready for possible bear encounters?
So whenever...
Well, before that, how many times have you seen bears on your trips?
Probably 10, 20.
Okay, so you see bears a lot.
Yeah.
I've seen them twice.
Yeah, I've seen lots of bears on the trips. They become... And it's funny, they're not going to kill you, so it's not a scary thing because we have mostly black bears. Black bears are pretty harmless. I think there's been 1 death in 20 years from a black bear. They're very different than brown bears and grizzlies and all this other stuff that are out west. We have black bears. They're more of an annoyance than anything else. But they are an annoyance. So when you go on a canoe trip, we always have our packs, and our packs will have some food in them. And bears are relentless to get at that food. You've seen them at the dumps, what they can do. And they can smell food from a mile away. So what we do is we have what we call bear lines. So all the packs at night before you go to bed, you throw a rope over the top of a big branch in a tree, and you have to pull these out far enough in the air so the bears can't get at them. So you gotta get them about 7 feet in the air so the bears can't get at them. And every now and again you'll see a bear swinging at them or whatever it is, but it's sort of a piñata for bears. You can't put them close to the trees because bears can climb trees. So you put them out a branch and you yank them up in the air, and that usually keeps the bears away. But that's our preparation. I mean, we don't not go canoeing because of the bears. We don't go to do anything bad to the bears. It's just preparation toward when you have to deal with them.
So it's interesting, where we have our place, we keep everything, we're not camping, so everything's inside the cottage. So the bears don't come into the cottage, but we collect garbage. We had a busy weekend. We had lots of people up. There was lots of garbage. So we have a bear bin outside. It's a garbage bin, but it's made of full metal, and it's got a latch so that it doesn't open. Yeah. But the key is you can't leave it there for more than 12 hours. If you leave that overnight with fresh garbage, even if you've double bagged the thing, the bear's coming out of the woods to find it.
Yeah.
And the bears have even figured out how to take those big garbage bins and roll them.
Yeah.
So they've figured out how to unlatch the latch.
Yeah.
So I've now got a stainless steel chain wrapped around a tree, wrapped around the bear bin, or the garbage bin, so that the bear won't take it out. And I always get frustrated when I see my neighbors putting their garbage out, knowing the garbage pickup isn't till 3 days away.
They don't track bears.
So, Mike, what happened last week in the stock market?
Well, it's not quite a bear yet, but again, something triggered the market to correct. S&P is down. We're Monday now, and S&P 500 is down about 7.2% since last Thursday. The Nasdaq's down 9.2%, so that's almost hidden bear territory. Something like Bitcoin down by 16.4%. And, the TSX actually held up reasonably well. It's down by about 4.1%. But what we're forgetting is that year to date, S&P 500 is still up by 10%. It's not a bad year for this.
Right.
This is all of a sudden a correction. Reason this correction happened, there's a few reasons. Number one, some economic data came out of the U.S. that said unemployment was rising. And they didn't think the government was quick enough on lowering interest rates in the U.S. because U.S. has been putting that off for a period of time. Second thing that happened, last week, Japan has had a very weird interest rate situation. For decades and decades now, they've had 0 to negative interest rates in Japan. And their society seemed to function on that over these decades, and it became a different type of stock market, and it functioned very well. The problem is people try to go and take advantage of that. So what people were doing was that they started to borrow money in Japan at these very low interest rates, at 0% interest rates. And what they would do, they'd take the borrowed money and they'd buy U.S. stocks. All these, let's say these Magnificent 7 stocks we're talking about, they're doing so well. And they would put their money into that, so low cost of borrowing, stock market's on fire, seems awesome, doesn't it? So
Great opportunity.
what could possibly go wrong? Last week, Japan decided to raise their interest rates. Not much. It's to a quarter point. Like, that's ridiculously cheap.
Right.
So
and it was coming from negative to zero practically.
Yeah. So it was -0, then all of a sudden they go to a quarter point. So it seems cheap to us, but these people have borrowed billions of dollars to make this work and invest into these stock markets. So all of a sudden the carrying cost went up for all the loans they had. Because remember, they're not getting a 0.25, it's 0.25 plus whatever
Plus
the risk.
bank prime, whatever
it is. So they're paying more than the 0.25, but this all of a sudden went up. So that's stage one of the problem. So stage two of the problem is what happens when interest rates go up to currencies. Currencies go up, right?
Yep.
All of a sudden the yen had a rally, so the yen took off. So now the money they owe is not even only at a higher interest rates, it's now owed back in Japanese yen, which has gone up, I think, by 5 or 6% compared to some of the other currencies, which means all of a sudden they have to sell their current holdings to go make payments because their loans are being called and they can't afford to pay it. So they have to start selling securities across the board to pay back these loans. So that's another thing that happened.
So you made an observation in a previous podcast about growth that everything has to keep being perfect. And if one thing starts to fall apart, the whole thing falls apart. Maybe this is what caused the next bear market. We're not predicting a bear market, but we are used to bear markets happening. When you go canoeing, you don't always think you're going to encounter a bear.
No, but I'm prepared if I do.
Right? When I take the garbage out, I don't think the bear's coming out of the woods because I'm taking the garbage out, but I'm prepared.
I went through, it was funny, I was doing some research. I went through the past large bear markets we had. And some things you always find in common. Let's say we go back to 2008. This is the subprime situation. The subprime was caused by financial institutions trying to make mortgages more attractive to investors by combining them together to reduce the risk in these tranches of mortgages, right? And that was something that worked very well for years that the financial institutions got involved in and pushed it to a much bigger scale. Exploded, right? No one expected beforehand, it exploded. If we go back before that, last one when we go back to 2001, the dot-com correction. Again, there are stocks that were in the, let's say, high-tech field that were doing very well. Then all of a sudden the banks decided, and banks, I'm going to use finance institutions, decided to come up with all vehicles for people to invest into these dot-com companies. And again, they made it so everyone was invested into these vehicles. It became a big, huge thing, then all of a sudden fell apart. You go back to 1987, Black Monday. That was another market run that was created by a bunch of vehicles that were getting people to invest. You see these common things that happen on these when you get these bear markets. They're caused by the financial institutions try to exploit something that's become very popular. And they continue to get exploited. People are invested in it. They don't really understand what they're invested in. They just know they don't want to miss out, right?
Kind of like Bitcoin.
A lot like Bitcoin. And I always think, and I think we've talked about this before, the next thing that's going to take a big hit in the market is some type of cryptocurrency. Something's going to go wrong there. And we don't know what it is or how it's going to happen. It may or may not. But there's quite a few, $2.2 trillion or something in cryptocurrency now. So that's become a big piece. And again, people are investing into it and don't understand it. And now the banks and financial institutions have created ETFs around it, and people are going to be able to borrow money to go into these ETFs with borrowed money and do that. It's, a recipe for some future disaster. It may or may not happen. It may be something else, but we know bear market's going to happen. There's going to be something that we look in hindsight and say, this is what caused the bear market of, I'm hoping it's 2028 or something, but it may be 2024. Who knows? But there will be a cause, and we'll know after the fact.
So what are we doing at the McClelland Financial Group to deal with a possible bear market, whether it's currently happening, whether it's 6 months from now or 2 years from now? I think one of the things, we work with what we call strategic asset allocation, which means we have a set recipe and we rebalance back to that recipe if it gets off target. So if you're more than 5% off target in a single asset class, we're going to rebalance.
We don't get carried away.
We're going to take profits from the areas that have done well. We're going to put it into the areas that haven't done well. we're always updating financial plans, but if we do get a bear market, we actually go and update the plan, whether we're supposed to be doing it now or not. We're going to update everyone's financial plan. All the financial plans are built expecting bear markets. So we don't go in thinking the financial plan's going to fall apart because it's a bear market. We actually know it won't fall apart. But I think it's important that our clients see that their plan has not fallen apart. Bear markets are inevitable. Market corrections are inevitable. Every year that the stock market has had a positive return, it has had a downturn greater than 5%. On average, the average downturn is 13%.
Yep.
That brings us to the end of another week. This is Rob and Mike with Think Smart from the McClelland Financial Group of Assante Capital Management.